All right, good afternoon, everyone. Recording this video after Saturday afternoon, and let's go ahead and jump into next week's data. Obviously, you guys know it's going to be very, very important. We already got the NFP report on Friday, and the market just absolutely got destroyed based on that data. It was a hot reading, and so the next step here for the month of January in terms of important data goes, it's going to come down to CPI and PPI on Tuesday and Wednesday, respectively. So let's go ahead and take a look here, see what we can kind of figure out, where we can make an educated guess where the market might be going after the report is out. So Monday, there's not going to be any news, but let's go ahead and take a look at PPI. All right, PPI on Tuesday, year over year, is expected to be at 3.0, so in line, and core PPI is supposed to come down to 3.2% below previous month of 3.4. So what's going to be important is to look at the core number, see if this comes in line or even lower, and or the PPI comes in lower here below the 3.0. I think two things can happen here. If the PPI reading comes in soft, the market could rally on Tuesday morning ahead of and gap up. Okay, and the reason I say that is because it's going to start pricing in the CPI, or the market anticipates a softer reading on the CPI data, which is actually a little bit more important to the PPI on Wednesday morning. So going to the Cleveland website here, the Cleveland website is suggesting that the CPI for the month of December is going to come out to 2.86. 2.86. We go ahead and scroll down here. The Wall Street forecast is actually 2.9%. All right. So what we're going to have to look at here is, will it come in at 2.9 or 2.8 or anything below? So if I kind of step back a little bit and say, all right, well, let's say we get a soft reading, or actually in line. All right, in line or soft at some point, possibly Monday. If the markets do gap down on Monday, I would believe that we're starting to price in bad news already on the CPI front. I'm not expecting us to go to all-time highs. I am expecting some type of relief bounce here. All right. So obviously the index has been down for 4 straight days. All right. So let's say we get a soft reading. All right. Soft reading at 2.8 to 2 down to maybe 2.7, 2.6. Okay, wait a minute here. That could be a huge boost in confidence to the market. So if, let's say, everything stays the same on Monday, we're at 578, 576 gap fill, I do think we're going to hit our target to 585 to 590 by the end of the week. All right, so that's one way that we can get those targets. Now, unfortunately, we have to also look at the bad side, right? So if the CPI do come in at 3% or 2.9 or hotter, okay, let's just say 3.0. I think we're going to get a pretty big gap down into possibly 570 and below, and hit this eventually at 564, 565 by end of the week. All right, 565. This would now constitute a 7% drawdown since the all-time highs. Now, mind you, if we get to this level, now we're getting pretty close here to the 200-day moving average. All right, the 200-day moving average at 555, about 25 points, 250 SPX points below current level. And I don't think that's too hard to actually get. So watch out for that 200-day, and that's where your final capitulation could occur. So one thing that that I'm very interested in right now is the fact that the put to call ratio is substantial at 2.28. So obviously very bearish sentiment. At this point, what's very interesting is that the number of open interest put on the put side that expires on January the 17th, this coming Friday. This is the most number of contracts that's about to expire this coming Friday out of the entire rest of the year. Okay, and obviously this data shifts every day, right? But this is significant. You're going to have to play a little bit of contrarian mindset here, is that are the market makers really going to pay out of all these puts side, or they're going to burn them all by Friday? So that's something to watch out for. Going over to IWM. Now we know that IWM is almost tapped the 200-day, missed the 200-day moving average by like 40 cents on Friday. All right. If you take a look at this and we go back to the rest throughout 2024, if IWM goes under the 200-day moving average and sustains itself under under the 200-day moving average, then yeah, I think the market's going into bear market mode. All right, or we're going to hit that correction of 10% highs. You take a look at IWM from highs to lows here, it's already in correction mode. It's actually down 12% below the highs. All right, so that means IWM has a lot of work to do. If the small caps, if the IWM gets a bounce this week, maybe off inflation data, etc., I think the market could rip. Okay, not to all-time highs, but you're going to see a pretty substantial move off the 200-day moving average. All right, going over to the Qs, I think that again, if we get a soft CPI, I think 512 to 515 is a worthy target. Below this current figure here of 502, we hit 503 on Friday, right? 503, 504. If you break below this previous all-time high here, your next level to watch is actually 493 because it actually goes and fills this elections gap. So if the markets actually want to take it there, I welcome it, because anything lower, we're starting to get to the 200-day moving average. And this is starting to feel like what happened here with the August carry trade, where the markets just kept gapping down, if you guys remember that, and it gapped it below the 200-day moving average just to rip higher. All right. So a lot of things to think about this weekend. All right. So going let me review my notes here. Okay, so one more thing that I would say. Okay, let's talk about this chart here. I think this will be our last chart for the weekend. Is the XLE divided by SPY, and this is the weekly chart here. All right, so this is where the 2022 inflation worries started to happen. All right, obviously we are seeing higher lows here on this composite. All right, but this look here before it took off here, it doesn't look anything like this. This is a pretty downward channel. Some could say that this might be a falling wedge look on energy stocks. All right, so if the market was really worried or becomes very worried about inflation, we're going to see this composite start to move towards this 200-day moving average. And then that will also be another sign of the times that we're going into potentially a correction on the S&P 500 index, and we know that IWM is already in correction area, all right, down 12% from the highs. So this is something to watch out for as well. So we got Tuesday PPI, Wednesday CPI, and that pretty much wraps it up. And of course, if one more thing here, TSM reports on Thursday morning, all right. A lot of good expectations for TSM. In fact, they gapped up on I think on Friday morning, right? Friday morning it actually gapped up because they were releasing some of their numbers already. So if TSM does well, we got a soft inflation reading starting on Tuesday with PPI and CPI. I think you could see possibly a 3 to 4 day rally back up because the markets are oversold. Taking a look at the breadth, okay, MA20 SP 500. All right, this is where we're at right now, guys. It's pretty bad. All right, we did get a nice size bounce, last week or so, heading into this year, but you can see that this breadth is starting to deteriorate once again here, and this is going towards, where we bounced from was actually 2022 bear market lows. All right. But if you take a look at this, there's no way that this thing can't move back up, because even if there's a bear market, guys, this thing stays within a range. There's always going to be a range. All right. There's always going to be a rip inside a bear market. Okay. So you can't just put all your eggs in one basket and says, okay, market's going down, we're just going to keep buying puts. No, the markets can rip your face apart by bouncing this statistic here when the breadth is too low or the fear is way out there. All right. We take a look at these numbers here, the put the call ratio. There seems to be some maybe a suggestion or a hint here that the markets could possibly rip on very good data, and also a rise in the sentiment for TSM and NVIDIA stocks and things like that in the semi sector. All right.